terms of a stock of the day, it is WiseTech Global, and they have held their AGM today. And it's the latest tech company to join the conga line of cost out programs, which is expected to deliver a net $15 million in savings in full year 24. WiseTech expects margins to return to above 50% in full year 26 and has reconfirmed its full year 24 guidance. And as we can see, the market has decided to turn, I suppose, the thumbs down a little bit to that one. So Luke, tell me, what do you think of WiseTech?
It's a brilliant business. You can't doubt that. It has been for quite a long time. But it's not cheap. You pay for that quality. $22 billion market cap, about 50 times EBITDA. And I think the concerns of the market is that as it's gotten bigger, that growth has naturally slowed. And in the past, most of that has been acquisitive growth. It's hard to do that as you get bigger. Acquisitions either have to get bigger or you need your organic growth to sort of supplement. And I think that's why, to your point in the introduction, they are investing heavier into the business, and it is that short-term hit to margins. And I think that's maybe an implicit admission from management that they need that organic growth to now really take over from what was primarily an M&A driven story in the past. The short-term reaction probably makes sense. There was just a throwaway line in regards to they're seeing some foreign exchange tailwinds, but they maintain guidance. Maybe the market was thinking, given the lower Aussie, that might have been an impetus to maybe guide to the higher end or raise, but they've sort of stuck and said we'll reassess it at the half year. So look, from a buy hold sell, I think it's a pretty easy hold. It was actually quite enjoyable to read Richard White's address today at the AGM. There's quite a lot of detail into a short, medium, longer term view of this business, and they've got some grand ambitions to be a one-stop shop in global logistics software, and that's ambitious. And if they get towards that, it's a stock that will do quite well, even from these levels and the current valuation. Manage some short-term headwinds, as you said, cost out program, maybe some weakness in margins, but given the founder-led mentality and that long-term ambition he's got, I think you continue to hold this stock, and maybe it's one that if you've got that longer-term focus, you pick up on dips and things like that in weak markets.
I thought it was really interesting the fact that they've expanded into Mexico, because currently the US has more trade with Mexico than China. It's actually surpassed China. So, growing a company just doesn't happen overnight. And I think sometimes, I don't know how you feel, but markets get very, very short term sometimes.
For sure. The market wants its hand held and be told, everything's going up in a smooth straight line. And in business, it just doesn't happen. And I have always appreciated CEOs, and you see it with founder CEOs who have that long-term mentality that they just tell you what the plan is and what they're going to do, and sort of let the market do what it does. And so that's why, as I said, I found that CEO address quite enjoyable to read. Richard's definitely got that sort of longer term focus, and so for the right shareholders willing to stomach some short term volatility, I think there's still a nice long term story here with WiseTech.
Fantastic. Claude, what do you think about WiseTech?
Well, I love high beta growth mode darling as much as you, Danny, but I actually have a different take on WiseTech from Luke, because I see it as being a pretty good business, a bit more of a roll-up than some of the other, growth mode darlings you might want to think of as a group, and they often trade together. It's sort of similar flows. It's like that growth portion of the super industry has its favorite growth stocks. You could say other ones nowadays might include Ordinate, Pro Medicus, Altium, Zero, Meta Group. That it goes on and on. Of that group, I think that WiseTech is not such a good quality business, because its growth has been less organic compared to actually most of those stocks I named. It's organic growth, and organic growth is generally more of a sign of a competitive advantage than just a roll-up strategy. So I don't actually see it as really fitting happily into that group. But the market does. And in fact, everything you guys were just, like Luke, what you were saying, sort of shows that is generally how people think of it. And at the risk of being wrong and a little bit contrarian, I actually don't think it's such a good business as everybody thinks. And as a result of that, I would actually say sell, and I don't hold it myself.
Okay, well, we love a good contrarian thought because that's what makes a market, Claude. So thank you.